Well, great to be here with you all.
They gave us the comfy chairs.
Yeah, we need different chairs next year. No, so lots to talk about in the seed world. As I'm sure all of you know, we're talking about the earliest stage companies out there. And the first thing I wanted to do was first to start off with a little bit of tough love for seed. I looked up the most recent PitchBook numbers for the seed stage. And for all the promise and tailwinds that young companies face, there is some headwinds. There's been 3 years of declining deal count in the seed stage, and this year is on pace to again fall. And then if you look at the share of overall deal making relative to other stages, seed has also been dropping. So I'm curious, one, what's driving these declines in seed? Two, is it even important to look at those numbers? And what's going to maybe turn it around?
I mean, the first thing that comes to mind is seed funding is the first part of a journey, right? A company raises seed, then they'll raise Series A and maybe Series B and Series C. And I think what we've seen, and Anna could confirm this, that it's just become increasingly hard to raise Series A. And that's simply because these Series A firms are becoming a lot more judicious about where they're putting their money to work. And so as we look at companies, we've got to ask ourselves, not only is this a great team, and is this in an interesting market, but is this fundable? Have there been a bunch of chips that have been laid on the table by investors in kind of like analogous areas? Because frankly, it could be maybe if it's the best entrepreneur in the world, but if you're like a really great entrepreneur operating in a market where the venture dollars have already been taken up, it's going to be really, really hard. And so what we've seen is this kind of flight to quality where it might be repeat entrepreneurs, it might be people that come out of academia that have some kind of unfair advantage in terms of what they're building. And those people can raise seed, and then they can raise Series A and beyond. The difficult part is for those people who are in the middle, where we're having to kind of really look into the future and determine whether or not we think that this is a company that can raise more money and then ultimately have a nice outcome.
Mm-hmm.
I think to add to that, a couple of things that are shaping the environment we're currently in. One is, what is a seed round? So a seed round used to be fairly well defined in terms of a valuation range and how big the round was. Now we see seed rounds it's a $50 million round and we're calling it a seed round. So the idea of what a seed round is has broadened. The second thing is that I think a lot of these rounds have conflated. So like it used to be this kind of nice, you do seed, you make progress, you do a Series A, you make progress, you're going along this kind of ladder or chain of fundraising. I think now there's a lot of people kind of swimming around in this phase of like trying to get product market fit, doing around you would call seed, and then all of a sudden they jump and now they're in growth. So the lines are blurring between.
But they might have raised several seed rounds.
Exactly. So they might raise multiple rounds that we would consider seed because they're all trying to get that product market fit. The other thing that's confusing and interesting, I think, is traction doesn't mean what it used to mean. There used to be, like in the world of SaaS, like a pretty close relationship between traction and product market fit. I used to say the only reason we care about revenue is it shows product market fit. It's not actually important in and of itself. But now, because there's so much experimental revenue and so much quick adoption of some of these AI tools, it doesn't actually mean that anymore. And so therefore, it's very hard to kind of have the yardstick and know what is a seed-ready company versus what is Series A-ready company. And that's making our job harder, and I think the job for founders harder.
Totally. I mean, as I think about a bunch of our companies that are going out to raise Series A in the next year or so, what they've got to show, not only do they have real revenue, but they have repeatability of that revenue, and they have durability of that revenue as well. Ideally, they're running a net dollar retention of 130%, with like gross dollar retention of 90+. And so it's all these little things that in the past, if you squinted, you might be able to look beyond them. But now, again, because these later stage investors are being so judicious, we've got to make sure the companies are set for the fundraise.
Mm-hmm. And I want to ask you guys about the lack of liquidity in venture overall. Many venture firms, it's been a while that they returned sizable capital to their investors. Their limited partners are perhaps getting antsy. And I'm curious how that, if that is making its way, the effects of that are being felt down at the seed stage? Because I know seed investors have always said we're very insulated from the public markets and also the going-ons of later stage venture stages. But is that still the case nowadays?
When you look at the data, this is actually, for the first time in probably 10 years, less competitive in terms of the number of teams operating, or number of funds operating at the seed stage. And I think that is a factor, especially for the small kind of seed participators. These were the solo capitalists who were raising, $15 to $50 million, typically from high net worth individuals who feel the pinch of liquidity way more than the institutions that have a 30-year horizon. And so for them, they would go back to the well to try and raise more capital, and their LPs were like, "Look, I love you, but I'm struggling with money. I'm certainly not going to write you a check for $250K." And so what that's meant is that there are fewer seed deals happening because there are fewer firms to make those deals. It meant that the share between like the lead and others has changed. In the past, it might be that a lead might take 50% of the round, and then the rest would be split with others. And now, actually, we see oftentimes a lead taking 60 or 70% of the round because they want the ownership, but also they're concerned they may not be able to fill up the rest of the round.
Mm-hmm. I think another thing that's having an impact on, it's actually easing the way for seed investors, is it's a much lower bar for companies to get to profitability now. Companies can go much further using AI. So whether or not you're a company that's offering an AI product, you can use AI to kind of scale your team. And so therefore, the risk of a company that will hit a wall because they can't raise follow-on capital is much better. So while exits the exit environment has changed. We're seeing, everyone knows we've seen a drought of IPOs for the past few years. We've seen less M&A, although some very encouraging numbers about the first 5 months of the year just came out on M&A, which was great to see that. But companies are able to build longer runway because the tools they have mean that they can go further with the capital that they have. And I think that's extremely helpful for seed investors.
Mm-hmm. And this was a confluence of two things. I think it's, as Anna says, kind of the AI tools allowing companies to be a lot more efficient. Mm-hmm. But it's also kind of like the hangover of the ZIRP period where Russia invades Ukraine, interest rates start to rise, and all of a sudden it was very unclear if any venture funding was going to be available. So companies just got really, really good at getting very, very efficient with their cash. And so we have companies that raised in 2021, and we'd always assume there'd be a 2023 follow-on raise. They may not need to ever at this point.
Right.
And like you have this concept of seed strapping. I love it when we invent new words. So, somewhere between standard venture funding and bootstrapping, seed strapping, you raise a seed round and then you work to use that round to get to profitability. Like that's a very trendy term right now.
Mm-hmm. You mentioned valuations. It was my understanding, seed was always a very attractive stage because you could get into companies cheaply. And then there was a time period when some larger firms, typically operating at later stages, sort of started creeping down into the seed world, and a lot of people said drove up valuations. And then now with AI, there's been lots of talk of AI driving up valuations. Is seed, are there still bargains out there, and how has that changed, or is it overstated? Is seed as cheap as ever?
So I'll give some context here because we are traditionally a Series A firm. Okay, so our core strategy is Series A. We've always invested at seed, but we used to call those discovery positions that would allow us to get to know a company in advance of the Series A, which is really our sweet spot. Our strategy now is we do core investing at both seed and Series A. And one of the reasons is that formerly you saw a lot of de-risking between seed and Series A in the form of proof of product market fit. Because of the speed of the market now, those rounds are conflating. And so in our view, there's not a whole lot of risk differential between seed and Series A. So all you're doing is paying more for something with a very similar risk profile. So we've moved down into seed, right? And we're not a huge multi-stage fund. We've got 1.3 billion under management, but there are huge multi-stage funds that I think see the same exact thing, and they are coming down into seed for the same reason, which is the risk profile has changed. They want to back the best teams. They think the chance to get their ownership is seed, and so they're out there writing checks.
Yeah, I think the other thing is that the landscape shifted over 10 years. Like 10 years ago, pre-seed was not a thing. If you're lucky, you could maybe raise some friends and family money, or maybe you went through Y Combinator or Techstars or AngelList or something like that, and then you would go and raise a $2 to $3 million seed round. I mean, today, $2 to $3 million is the size of kind of like a mid-sized pre-seed. And what that's meant is that companies are, if we're writing we're leading a $5 or $6 million round, they're going to be just more mature than they were. They're probably still thinking about dilution, and so the dilution that they get for a $3 million round is probably going to be there or thereabouts for a $5 to $6 million round. And so the prices just went up. Everything just kind of shifted right a little bit in the ecosystem. And I think as we saw kind of knock on at Series A and Series B, to Anna's point, a lot of those kind of multi-stage firms are like, well, shit, I want in on this action. if I can get a company at 25 pre instead of 250 pre, I'll do that all day long.
And if the market, when the market begins to heat up again, do you anticipate that same phenomenon happening of large firms creeping down into the seed world, and you're going to have to compete with them?
I'd argue the market's hot right now.
Yeah.
If you're building something that VCs care about, and frankly, it probably means you have a .ai domain name, then you will be great team and interesting space. You're going to be swarmed by VCs. I think the challenge, for any founder is like figuring out what's the right capital to take. And I'm going to talk my own book here. And like, if you're raising seed money, you want to raise seed money from people that do seed. You get a $3 million check from me or Anna, that's meaningful for us. You get a $3 million check from somebody investing out of a $2 billion fund, it really doesn't matter very much.
It's a financial investment for them, right? Whereas for us, it's our bread and butter, and we've developed ways of supporting our portfolio that go far beyond capital, because that's the stage we focus on, early stage. I would argue that the large multi-stage funds no longer have a concept of stage. This wasn't a temporary strategy. This is now the new MO. And you see a lot of the multi-stage funds also launching incubators, launching accelerators, having one person that focuses on seed, pre-seed, right? It doesn't...
Buying a hospital system in GC's case.
Doing private equity, right? So it's not... So their strategy is just multimodal, right? So that you have that on one side, so call them asset managers, and then you have the focused, strategic, early-stage specialists that have a very specific point of view. And ideally, I think you have both types of capital, at some point, early stage funds like ours, and then later stage when you're looking for growth, those larger funds.
It seems like almost every day there's a new AI innovation out there that could potentially change the playbook for building a company. Curious, investing in companies at such a young stage, how do you see around corners to try to predict, not just what technology is doing today, but what it's going to be doing, months, even year plus down the line when these companies are going to mature?
I think it's impossible to do that. We'd all like to claim that we have a crystal ball and we can see into the future and we can be entirely prescient. But the fact of the matter is, when you invest as early as we do, it's all about the team. It's about the founders. It's about their kind of special skills. It's about their experience. And it's basically a bet on the fact that they will be able to roll the punches, because there will be a lot of punches over that 10 to 15-year journey in order to figure stuff out. And that means, market dynamics changing, technology dynamics changing, new competitors coming out from the woodwork. And it could be a new startup competitor. It could be that OpenAI decides that they're going to build something which is competitive to you. And there's always been this notion of like, oh, what if Google built this, or what if Microsoft built this? I think what we're seeing today, though, is that this next generation of multi-billion-dollar companies are so good at building and so fast. If you're building in fintech today, you ask, like, why wouldn't Stripe build this, for example?
The technology changes. The principles of early stage investing remain the same. It's about the founders. It's about their ability to listen to their customers, to solve a real problem instead of build something cool and then look for a way to sell it. It's about being willing to continually learn and pivot. And I like to talk about the combination of swagger and humility. So Swagger, you have to be ridiculously confident to be able to say you're going to build a massive unicorn company starting from nothing. Like, that's insane. So you have to have that level of insanity, and you have to have humility to know when the ground shifts under you that you have to move. So it's just like comes back to the basic things that have always been true, which is looking for founders that have that right profile, and that, kind of learning instinct and ability, especially now in this world of AI when things are changing so quickly. That's even, more important. But real customer problem, focus on the customers, be willing to learn and surround yourself with amazing people.
And I think it's very easy during kind of like a technology revolution to lose sight of kind of what we should be doing here. We should be building companies that serve a customer need. Building companies where there is a real problem, either a consumer problem or a business problem to be solved. Because frankly, all the AI in the world isn't going to magic up the need if it doesn't exist already. And then, to something else that Anna had said, there's a great quote from a VC that I respect a lot, a guy called Hunter Walk from Homebrew. Hunter says, like, his view on kind of where they invest, he's like, we invest in founders we love, building ideas we don't hate.
Mm-hmm. For the founders out there, could you offer just a couple, green flags that you look for when it comes to being able to roll with the punches, as you guys put it?
Yeah, I would say having a really specific plan and then being able to point out what are the assumptions behind that plan, right? So if you get asked, like, what could go wrong, right? Like having an answer to that and like understanding what are the baseline assumptions that you're making, because there's always assumptions based in there. That gives me a lot of confidence because I want to hear that you don't know all the answers out there. I would say being able to really creatively bring early customers in to give you feedback and having gotten insights from that is something I really look for. And then having had a repeated pattern of not necessarily even being a founder, but starting things, building things, like showing this habit of seeing a problem and building a solution, seeing a problem, building a solution. We look for those kind of patterns.
I look for founders who are maniacally focused on what they're building, who have some kind of unique insight, and it could be from a past job, it could be from their education, it could just be, we backed 2 really smart kids in 2015 building a next generation applicant tracking system for frontline workers because they lived that life as those workers. And what I want to hear, in, almost like the first 10 minutes of that pitch, is the founder selling me on like why they are uniquely placed to do this, why this is the only thing they think about, why they're going to be doing this hell or high water, even if it means they have to go and flip burgers, they're going to work on this company. Because, it's really hard. Startups are unbelievably difficult. And if you don't get the sense that that person can persevere, it's just not worth the risk.
Mm-hmm. I'm curious to hear your thoughts on that desire to persevere and being maniacally focused with knowing when to pivot. And, companies like you said, you've got to be able to roll with the punches. And it seems like it can be a difficult thing to put your finger on when it's time to stay focused and power through challenges versus when it's time to, as a super young company, be nimble and kind of adapt to what's being thrown at you.
It's the difference between knowing where you want to go and being 100% certain that you're going to get there, come hell or high water, and then knowing how you're going to get there, right? You got to be very flexible on the how and very determined on the what and the where, right? So I invested in a founder called Nicole Schmidt, who's based in Portland, Oregon, and is building a platform for procurement in the commercial construction industry, right? Not the sexiest space, absolutely compelling and fascinating to her because she had been a rep for a brand and she understands construction procurement inside and out. And she is 7 years later just hit an inflection point after having been through many, many pivots, a lot of changes on the team, and a lot of learning about the business, right? Because she said, my life is about solving this problem.
And the conversation around AI and valuations is always an interesting one. I think a lot of people just find it inherently difficult to nail down what an AI company is worth, especially considering how quickly things are changing. How do you guys approach those discussions with founders? Imagine it's not an easy one.
This is an age-old conversation, though. What is my startup, which is 2 years old and has 0 revenue? what is it worth? Is it worth $0? Is it worth $10 million? Is it worth $100 million? It really is all about kind of finding the market clearing price. What is it that we are prepared to pay to underwrite the risk to buy future value in this thing, knowing that, unfortunately, 80, 70% of companies won't work. I think AI has only made the pace of that faster, but I don't think it really changes the calculus.
Mm-hmm. Yeah, like Andy said, right, it's really about willingness to pay. I feel like it's a bit of a red flag when founders feel too focused on valuation as an outcome, because capital is just really like a means to an end. And so there's a better way to triangulate into that, which is how much capital do you need to solve the next set of problems you're going to solve, and how helpful do you think Andy's going to be, or I'm going to be, or our firm's going to be to like helping you get there. All those things kind of have to be factored in. And then what makes, we look for win-wins. What makes it a great deal for everyone, that everyone can feel terrific about that outcome and super excited to work together. Mm-hmm.
Changing gears slightly, I want to ask you guys about the age-old question of tech hubs and geography. It was such a pandemic trend to say that venture capital was spreading throughout the country to these unsuspecting tech hubs. My publication recently had an article saying that trend is perhaps reversing.
Was that the article about Europe?
It was about Austin.
No, that article about Europe was written by my brother-in-law,
no way.
David Luno. Yeah.
Great article.
I'll let him know you said that.
So yeah, where do you guys fall on this line? Are tech hubs?
Well, given I'm in LA and you're in SF, I'm sure we have an interesting point of view.
So look, the first thing is talent is everywhere. I've met a bunch of VCs here over the last couple of days who, they work in Vancouver, they work elsewhere in Canada, they're working elsewhere in the US. And I think what they've seen is that the center of gravity back to San Francisco in the last 6 to 9 months has become so strong that they feel like their job today is to find incredible teams, get them going, and then help them make the move over to the Bay Area. And this has basically been the Israeli model and the UK model for the longest time. If you're building broad consumer or broad enterprise technology, you kind of have to be on the West Coast. And maybe it's not SF, maybe it's the Bay Area, maybe it's Seattle, or maybe it's LA. But just the concentration of talent, the concentration of capital, and the concentration of both partners and potential acquirers is unbeaten.
Mm-hmm.
Yeah,
what's the LA perspective?
I agree with that. To be honest, at this moment in time, I think there is a massive advantage early on to being in the Bay Area for an AI native company. I have been a huge fan of finding founders in other markets because, to our conversation before, I think they often have a specific insight about a customer problem in an industry that you might not find inside the Bay Area. But I think if you are selling to enterprise companies, you are building with AI talent, it's really tough to make that speed of progress, in other places for right now. That could change.
And it's not like you have to be in San Francisco. I just think it just feels like right now, to give yourself the very best possible chance of success, you might want to consider it.
Okay. Well, that's our time. Thanks, folks.
Thank you.
Thank you. Thanks, Mark.